If you've noticed the numbers climbing at the gas pump lately, you're not alone. While oil is a global commodity, the current surge in U.S. prices is being driven by a decades-old geopolitical rivalry that has reached a boiling point. The United States and Iran. In the world of energy, markets don't just react to what is happening. They react to what might happen. Richt now. The tension between Washington and Tehran is creating a risk premium, a polite way of saying the market is terrified of a supply disruption. The choke point, the Strait of Hormuz. To understand why a conflict thousands of miles away affects a commuter in Texas or New York, you have to look at a tiny strip of water, the Strait of Hormuz. Roughly 20% of the world's total oil consumption passes through this strait every single day. Iran sits right on the edge of this waterway. Any escalation in military tension leads to fears that Iran could attempt to block or harass tankers, even if a single drop of oil hasn't been stopped yet. Traders buy oil futures now to hedge against the possibility that the strait becomes a literal battleground tomorrow. Sanctions and the shadow fleet. Then, we have the diplomatic chess match. The U.S. has maintained heavy sanctions on Iranian oil exports for years, aiming to cut off Tehran's primary source of revenue. When tensions rise, the U.S. often threatens to tighten these sanctions further, targeting the shadow fleet, the unofficial tankers Iran uses to get oil to global markets. If the U.S. successfully removes over 1 million barrels of Iranian oil from the global daily supply, the math is simple. Lower supply with steady demand equals higher prices. Investors also worry that Iran might retaliate against these sanctions by targeting the energy infrastructure of U.S. allies in the region. The domestic impact on the U.S. A common question is, if the U.S. is the world's largest oil producer, why do we care? It's a fair point, but there's a catch. Oil is priced on a global exchange. If the price of Brent crude spikes because of Iran, the price of West Texas Intermediate, the American benchmark, almost always follows. Additionally, U.S. refineries are often calibrated to process specific blends of oil. We export a lot of light crude, but we still need to import heavier grades. Any disruption in global flow upsets this delicate balance and drives up the cost of refining gasoline at home. Conclusion: the unpredictable horizon. Ultimately, oil prices are currently a barometer for geopolitical stability. As long as the rhetoric between the U.S. and Iran remains heated, and as long as the threat of maritime interference or infrastructure attacks exists, the market will remain volatile. We aren't just paying for the oil itself. We're paying for the uncertainty of tomorrow. Until a diplomat of Rampis found those numbers, Palam are likely comfortably